Hey everybody, Tim Ulbrich here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, Tim Baker and I wrap up our two-part series on 10 common Social Security mistakes to avoid. Now, whether you're a new practitioner where Social Security is far off in the distance, perhaps in the middle of your career listening, or approaching that timeline towards retirement, I recognize that many listeners may not be aware of what the team at YFP Planning does in working one-on-one with more than 280 households in 40 plus states. YFP Planning offers fee-only high-touch financial planning that is customized to pharmacy professionals at all stages of their career. If you're interested in learning more about how working one-on-one with a certified financial planner may help you achieve your financial goals, you can book a free discovery call at yfpplanning.com. Whether or not YFP Planning's financial planning services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. Okay, let's jump into my interview with Tim Baker, where we complete our 10 common Social Security mistakes to avoid. Tim, welcome back.
Good to be here, Tim. How's it going?
It is going well. I'm looking forward to part 2 of our series on 10 common Social Security mistakes to avoid. If you missed last week's episode 294, make sure to check it out. Link in the show notes below, where we covered the first 5 common Social Security mistakes. Tim, we talked through not checking your earnings record and making sure you've got a good view on what's going on in the SSA.gov profile and some of the tools in there. We talked about not knowing some of the specifics of the benefits that are available with spousal benefits and disability benefits. We also talked about how benefits are calculated, and then some of the strategies around potentially the timing of claiming Social Security. So a lot of information in that episode. Make sure to check it out. Tim, let's jump right into number 6 on our list of 10 common mistakes, which is the cost of living adjustment. We talked briefly about this last time, but it really needs the attention that it deserves. So tell us more about the Social Security COLA and how that works.
Yeah, so every year, the government looks at the consumer price index for urban wage earners and clerical workers, and they do this. I think this is in the fourth quarter, and then they announce based on the CPI-W, they announce what the change in payments would be for Social Security or other government benefits. And this year was, most years it's very incremental, right? Because inflation hasn't been what it was, year over year from 2021, 22, what we've seen. But last year they announced, and then put into practice that the benefit would increase by 8.7%, which is huge, Tim, if you think about it, because if we take a step back and we talk about one of the major pieces of the retirement paycheck, obviously, is Social Security, which is what we're talking about. But the other major piece is the investment portfolio. So one of the reasons why we put our money into the markets and we hopefully take aggressive but intelligent risk is because, unfortunately, we can't stuff the mattress full of cash and then hope that in 30 years when we go to retire that's going to be enough to sustain us. So the reason that we invest and we earn dividends and we earn capital appreciation on our investments is to outpace really 2 things. It's the tax monster and the inflation monster, and that's why we do this. So one of the beautiful things about Social Security is that it is inflation protected. So your payments, going into from December to January, got almost a 9% bump, month over month, which is huge. And what we have said is that they don't even sell annuities on the market right now, as I'm aware, that has a cost of living adjustment rider, which means that I could say, so when I'm talking about annuity, all an annuity is your own Social Security benefit that you're creating yourself. So it's where you say, hey, I have $100,000. I'm going to give this to the insurance company, and then they're going to pay me for life or for a term certain, X amount of dollars per month for that lump sum of cash. So I can't even go out into the market and say, hey, you see what Social Security is doing, where they're giving me that 9%, or hopefully it's not that big. We don't have inflation starting to temper down. but it could be 5% next year. It could be,
Yeah.
it could be 7% the following year. You can't even get that on the marketplace. So Wade Pfau, who is, a professor at the American College, he's written a lot of books on retirement. He's basically saying that Social Security is, really the cheapest annuity money can buy, even the whole deferment process. So you can't even get that on the market. Now, what you can get, Tim, is, you can get a rider that says, hey, it'll go up 3% every year or 2% every year. And that's typically the component that drives the price of the annuity. Because, 2 or 3% could keep pace with inflation. But this year, you're like, hey, you're down 6% if you have a 3% rider, based on the difference. So really what we're doing with Social Security and it being protected by inflation is we're protecting your buying power. We know that the price of gas, the price of eggs, the price of other groceries, housing, utilities, everything has gone up. And for a retiree on a fixed income, that can be super stressful. But at least if a good portion of your retirement paycheck is protected by this inflation protection, it's a little bit of a a feather in the cap. So Social Security payments, just to clarify, they're adjusted every year based on inflation, based on that CPI index. And by law, this is another important thing. By law, an individual's benefit can't decline, even in deflationary times. So, that's one thing that, your payment, it could stay or your benefit could stay the same. Usually it goes up every year, but when we've had a year like this, where there's been a lot of inflation, you see that, matched in, the benefit increasing by 8.7% this year. So I think that this is one of the things that is often overlooked. And, when we're buying policies or doing things, like cost of living always comes up, and it's one of the more expensive things because it's just an unknown. We just don't know where it's going. So the fact that the government has our back in this regard, and again, a lot of people, we pay for Social Security, like that comes out of your check every time. So it's not, this isn't, this is just allowing us, or the government allowing us to kind of get those payments for life. So they're doing what they need to do on the back end, to make sure that that is sustained. But, to me, this is an important piece, that it is inflation protected. And again, being on a fixed income, there's risk there that if you're not, you're just being priced out, and, your standard of living is affected without it.
Yeah, Tim, new news to me. That's really neat. I wasn't aware of the, essentially the floor, right? That they're in a deflationary time period, that, the benefit can't go the other way, which makes sense, right? That while some people are using Social Security benefit, obviously, for goods and services that are going up with inflation, or in a deflationary period, those costs would go down. There are other things that are fixed, right? That aren't going to go the other way. So that would make it difficult for planning. Tim, I was feeling good about my high yield savings account with Ally at what, 3.4, 3.5,
3.4
till I saw 8.7. And I was like, oh man, still losing, right? Against inflation. So
and you know what? Every little bit helps. Again, most banks, they kind of just collect that money on the float. So I like seeing those payments roll in, even though I know that it's a jungle out there with inflation.
I'm glad you mentioned, the tax monster and the inflation monster. Obviously, we just talked about the inflation monster and addressing that with COLA. But our number 7 common Social Security mistake really gets to the tax piece. And I think, as we've talked about many times on the show, tax, like inflation, is often an overlooked part of the financial plan. So, Tim, when it comes to this number 7 mistake, not planning for taxes on Social Security benefits, another example of the integration of tax planning with the financial plan. So how are Social Security benefits taxed, and how could this impact potentially someone's decision to whether or not they're going to earn additional income as well?
Yeah. So again, to your point, shout out to, our tax team at YFP Tax, Sean Richards and Paul and Ariel. I think this is another indication, or another example of having, a professional look at this and help, decide on this is important. So one of the things that people don't know is that up to 85% of your Social Security benefit could be, taxed at the federal level if you earn substantial outside income, such as, wage or dividends. And really the benefit, Tim, the percentage of your benefit that's subject to income taxes really depends on what's called your combined income. So your combined income is essentially 50% of your household's Social Security benefit plus any other taxable income, which could be wages that you receive from a W-2 or 1099, plus any tax exempt interest, which is typically things for like bonds, that type of thing. So 50% of the Social Security benefit plus taxable income plus tax exempt interest income. So that's essentially your combined income, and that's how it is determined, like what your tax will actually be. So one of the interesting things is that back in the 80s, I believe it was the 70s, 80s, a smaller percentage of people's Social Security was being taxed. And a lot of it is because some of these thresholds that they've set were not indexed for inflation. But as time has gone on and people have earned more money, we've seen it creep up to where now, as a recent study projected that going forward, about 56 of beneficiaries will pay taxes on at least some of their Social Security benefits. So it's good to kind of sit down and see, okay, if I'm earning additional money, or I have a portfolio that spits out off income, how does that affect what I'm going to pay taxes on? And then probably even a broader conversation is really, okay, if I do additional work, am I going to lose some of my benefit, which is also a misnomer and probably something that should have made this list as well. You don't necessarily, like, if you make a lot of money, you don't necessarily lose the benefit. You just don't, they just kind of pause it and they give it back to you later. So, earning money in retirement, so to speak, is actually a great strategy, but understanding kind of the tax and how it affects the benefit itself is important to know. So, it can be great because it, obviously helps, maintain the portfolio and all that stuff. But, it's really important to understand that the tax is, and again, if you work with an accountant, a CPA, an enrolled agent, they should be able to walk you through, okay, this is what, the tax bill is going to look like on your Social Security benefit. And I think that's an important piece of the puzzle as well.
Yeah, and Tim, it's reminding me back to on 275, we talked through how to build a retirement paycheck, right? And you talked about that a little bit on the last episode as well. But so important. I mean, at the end of the day, like for planning purposes, we want to know like what is the take home, right? What's the net, so we can plan for our expenses and goals and other things that we're working towards. So, another good example, as you mentioned, of not only thinking about the sources of income, one being Social Security, that are going to make up our retirement income, but what are the tax implications and the tax optimization strategies to obviously pay our fair share, right? But no more, right? We want to be able to allocate those dollars.
Yeah. And if you know that your tax bill is going to be higher for that year, maybe the paycheck, the sources really coming from things like, a Roth account, which you've already paid the taxes on, or an after-tax account, which you might have to pay capital gains tax on, but that's different than ordinary income tax. And you leave the traditional accounts, alone a bit, and that's why at the end of the day, a lot of people ask me, like, what proportion should be in pre-tax versus Roth versus like a taxable account. And it's tough to say, again, depending on like where you live and what you're doing, and because state taxes are different. But I think it's a good bet to have a little bit in column A, a little bit in column B, and a little bit of column C, and be able to kind of like pull from those different accounts depending on what's going on in that time of your life. So just again, having that optionality is another key theme in all of this.
Tim, as we move on to number 8 on our list, which is assuming Social Security benefits can fully cover your living expenses. I think we've highlighted well the benefits of Social Security. We talked about the COLA. We talked about, potentially the size of that benefit. You gave some examples in the last episode, as you were looking at your SSA.gov online portal. And I think maybe some folks might be listening and be like, man, like, do I need to be saving as much as I am outside of Social Security? Like, could I potentially depend more upon that than I was planning? So what is the potential mistake here in assuming that Social Security benefits can fully cover your living expenses?
Yeah, I think it's, when we're hearing like, wow, it's COLA, and if I can work to 70, well, I'm gonna work to 70 anyway, so it's funny because like a lot of clients that come to us and maybe they have a couple $100,000 in debt, they'll be like, man, I'm never going to retire. I'll never be able to retire. And then we kind of start to deconstruct, the debt repayment. And then we start to get them, in a portfolio that does its thing. And, over a couple of years, you can start to see the script flip, so to speak, on, okay, like I think there's a path forward. And in a lot of those scenarios, we're not even really accounting for Social Security, in a lot of ways. We say, we're going to plan for us as if it's not there, but the reality is it will be there. And again, it might be, depending on how far away you are from retirement, it might be a lesser benefit. But I think, it is definitely a mistake to say, and some people do believe this, that it's like, hey, I'm going to do what I'm going to do what I can do in my 401k, in my IRA, and I'm not going to kill myself because I know that, the Social Security benefit will be there for me. And I would say that is, again, if we're talking about optionality, if we're talking about, we don't really know how long we're going to live, we don't really even know how long we're going to be able to work. All of those things, I think, tend to, say, hey, let's do what we can to kind of make sure we have a good, healthy portfolio that we can draw from. We don't know where inflation is going to be. We don't even really know where the U.S. markets are. Again, I still feel super bullish about that, but the fact remains that, it is, unknown. But I would say that, and these are really beginning of 2022 numbers, the average for all retired workers, the benefit is about, it's $1,657 per month. That's 20 grand a year, Tim.
Yeah. That's
And
lower than I would have thought.
Yeah. And I think we're actually but I think that for so many people who are collecting this benefit, the mindset was like 62 and go, like, it's like, once I get to that, I'm going to get the money because I'm only going to live to 68 or 69 or 70. So I want to get the money while the getting is good. We're starting to see that trend really shift, where I think people are starting to understand, okay, I can defer, or they're just naturally working longer, because of, some of the aforementioned things like debt, student loan debt, et cetera. The average for older couples in situations where both spouses receive benefits, is $2,753 a month, or about $33,000 a year. So again, like, and there's a lot of different ways to kind of skin the cat, so to speak. But a lot of planners will say, okay, if you make $100,000 as a household, they'll use anywhere from 60 to 80% of that, of those dollars, and to say, hey, you need $60,000 to $80,000 to live, because they discount it. And a lot of the discount is based on really the fact that, like, while you're in retirement, you might be saving 10, 20, 30% or more. And then the also idea, although it's not necessarily true in early retirement, because you're typically a kid in the candy store, we're like, wow, I need to go do all the things I deferred while I was working. So travel and that type of thing. So there is a little bit of a smile, so to speak, of spending, where, it starts higher and then it starts to come down as you age. And then as you age, medical expenses get, larger. So it kind of increases.
Yeah, that makes sense.
But when you compare that, again, 100,000, most of the clients that we're working with are making a way above that, as a household. So 100,000 in, 33% of that is covered. It's not a huge portion of that paycheck. And it's even going to be smaller the further you climb up kind of the pay ladder. So it again, this is to say, and we're kind of talking out of both sides of our mouths, how great of a benefit it is, but it's also to say that it's not going to be the end all be all for you in terms of retirement, unless you are, your lifestyle just says, hey, I can live off of $33,000, which, so maybe some people can do that, and go from there. So to me, that's a big thing. So if we look at some of the other stats, Social Security will be a major source of income for many retirees, especially like lower income levels. It represents about 30% of the income for older adults. And specifically, when you kind of go down from a gender perspective, about 30% of men and 42% of women receive at least half of their income from Social Security. And then probably one of the more concerning things is that roughly 12% of men and 15% of women rely on Social Security for 90% of their income. And again, hopefully the people that are on, our listeners, because of, some of the, I think some of the socioeconomic differences, and resources available, and hopefully, the education, that they're receiving from a financial literacy, that will not be them in the future. But it is safe to say that, it could be, 20 to 30% of what you're relying on, which is, again, is a
Yeah.
good chunk of money. And
Yeah.
if that can grow because we are deferring and it is inflation protected, that's the power of the Social Security.
Yeah, and Tim, this reminds me, one of the takeaways I've had just from listening to you teach and talk on this topic is to really, really kind of avoid the polar extremes of views on Social Security, right? I think there's some folks that, especially maybe earlier in their career, are like Social Security is not going to be anything. And we kind of
Yeah.
established why that probably won't be the case in the first episode. And then here we're talking about the other side of the spectrum, which is assuming it's going to fully cover, all my expenses. And I think for obvious reasons of which you just highlighted, probably not going to do that, for the vast majority of folks. But it can be a really good in between, just like we talk about building a foundation early in your career with the financial plan here. Like you've got this foundation, or at least some of the makeup of the floor, that's going to give us, some insurance. It's not nothing, but it's also not going to be everything, that we
Yep.
need as it relates to retirement planning.
Yeah, and like we mentioned before, like if you're pretty conservative in your approach, if you can get Social Security and, maybe annuity that you purchase by peeling off a couple $100,000 of your investment portfolio, and you can say, okay, this check from Social Security plus this check from, the insurance company for my annuity is going to provide for all of the necessities
Mm-hmm.
that I need.
Mm-hmm.
Um, like there's a feeling of freedom there. Now, someone who has more appetite for risk, they're like, well, I would almost rather just kind of spend down my portfolio and be able to, enjoy the things what I want to enjoy without paying that huge bill up front. Um, but there's also, stress of saying, okay, hey, the market's down 30% and I'm drawing on it. Versus
That's
if
right.
like you were just getting that paycheck built in. So, there is a different approaches based on your appetite for risk. And what we're just kind of
Yeah.
describing here is the flooring strategy versus the systemic withdrawal strategy, who I think, can be, and you can have hybrids of that as well. But,
Yeah.
yeah, important to kind of see what is the best way to tackle it for you and go from there.
Tim, number 9 on our list of 10 common Social Security mistakes refers to those that may get divorced and then potentially remarry as well. Talk us through what are the implications of the Social Security benefit for these situations.
Yeah, so sometimes people don't know that if they're divorced and, the marriage, the failed marriage, kind of meets certain, criteria, you're actually eligible for a benefit based on your spousal's Social Security record, or your ex-spouse's Social Security record. So
Mm-hmm.
so essentially the rules for this is that you have to be divorced. The marriage has had to last at least 10 years.
Mm-hmm.
You are age 62 or older. You're still unmarried. And then your ex-spouse is eligible to receive a Social Security retirement benefit or, disability benefits. And your benefit, so if you're a worker, your benefit from your own work is less than what you would receive under your ex's earnings record.
Yep.
And the other interesting thing, which kind of makes sense because they're, as a divorcee, you're not like, you shouldn't be all up in like your ex-spouse's like business and when they're going to retire and claim, but they don't need to be claiming the benefit. Whereas
Mm-hmm.
if if I'm married and my spouse can't claim on my benefit unless I've claimed the benefit. So those are really the rules. So like again, you might be where, you know as part of your, if you're kind of been, if you've been married for, 9 years and you're looking at divorce, it might be best to kind of get to that 10-year mark, so stay married longer to activate that benefit.
Yeah.
Or even just in your, as you move on and have other relationships, whether, you want to, actually marry or not. So, because once you marry, then that comes off, and then you're kind of tied to
Mm-hmm.
your new spouse's, benefit and that type of thing. So it is one of those things that, obviously Tim, divorce can be a very emotional thing. And we would never
Mm-hmm.
advocate for someone to to be in a situation that, is unsafe or it doesn't, make sense for them. But if it's kind of a more of an amicable thing, it is something that you should definitely, use and understand, in terms of a strategy. The interesting thing, Tim, and I was listening to a lecture on this. You could, if you're married and divorced multiple times. I mean, you could have a stable of ex-spouses that could be claiming on your benefit, and that's kind of where maybe some of the inefficiencies. If I have 3 or 4 ex-spouses and they're claiming off of like one worker's benefit that's been paid into, and then there could be children involved with that. It can, the bill could pile up, so to speak, for Social Security. And I wonder, this is just me speculating out loud. I wonder if this is one of the things they potentially tighten up, in terms of like what this looks like in the future. So we know that obviously divorce is a reality for a lot of Americans, and obviously this is a benefit that, should be there. But I wonder if this is one of the things that they look at in the future.
For the record, Shay, nothing to worry about. Tim mentioned 3 ex-spouses, just an example in case she's listening.
Yeah, exactly right.
This is the test, right? Is Shay listening to the podcast or not? We're going to find out.
She says she does. She says she does, but I probably need to like quiz her or, drop some.
Well, this is deep into part 2 of a series. So like,
I know for her, she's probably sleeping, or fell asleep listening to me talk about this stuff.
All right. Number 10 on our list is looking through the wrong lens. Tim, this is a new concept for me as it relates to Social Security and looking at it as an investment framework or an insurance framework. Just describe the difference. Tell us more here.
Yeah. So I think so many people, when they approach the decision on when to claim, they look at it from the vantage point of like, okay, if I've put money into this system over the last 30 or 40 years as I've worked, I want to get as much money back and more. So a lot of advisors would use what's called a break-even analysis. And basically they would say, okay, if you claim at 62, here's your reduced benefit. But if you were to wait to claim at 70, there's 8 years where you're not claiming it, and it's at an increased benefit. So where do those kind of cross? And for a lot of people, it's, usually between age 80 and 84. So if you're like, oh, well, my Uncle Donald or my Aunt Ginny or whatever died at, 78, then I'm like, I'm definitely taking it early. So, and many retirees, they live a lot longer than they think they will. So, the average life expectancy for a 65-year-old, that's a participant in, so an average, how do I say this? The average person at 65, they're going to live, once they get to 65, there's a really good chance they're going to live to 85 and beyond.
Yeah. Life expectancy increases once you get to a certain age. Yep.
So I feel like too many people think of it as an investment that only pays off if they live a long time, and they worry too much about what happens if they don't live as long as they expect. So the thought is that this framework gets the focus. This framework focuses on the wrong issue, and dying young instead of living a long, kind of retirement with a good kind of standard to live in. The opposite one, where I think the decision really should reside, is in the insurance framework. So why do we buy insurance? We buy insurance because we want to mitigate risk. And typically, the longer that you defer, and again, this is not advice because everyone's situation is different, but typically, the longer you defer, the more you kind of scratch the itch of mitigating some of these risks related to retirement. So one being longevity risk. So longevity risk is that you live too long where you're going to basically outlast your money. So deferring Social Security, and looking through for that framework, you get a larger stream of lifetime income. Long-term care risk. So one of the things that I talked about with Smile is that you could get to a point where, you need to, use nursing homes or that type of thing. So because you deferred Social Security, you have more resources, i.e. in your portfolio later in life, to kind of cover that. Inflation risk, again, we've talked about this, in a larger percent of your income is protected against inflation. That's a beautiful thing. Things like frailty risk, which is as you get older, and cognitively, you might not be as sharp as you were. This really simplifies the decision making, because again, a bigger portion of your income is kind of covered and it's inflation protected. Even things like elder financial risks. So streams of income are less. They're going to be they're less at risk to kind of be stolen and taken advantage of, versus like a couple $1 million in an account. Excess withdrawal risk. So this is where you're locking in larger income stream in Social Security, so eliminating risk of generating income from the portfolio assets. Again, market risk, it eliminates volatility and returns. And then early loss of spouse risk, where you're deferring, again, a larger benefit. Even if I'm in poor health and I defer my benefit, when I were to pass away, even if it's sooner, it might be larger than what Shay would do. So at the end of the day, you kind of look at it from the standpoint of, okay, if I have a short retire, so if I look at this from the strategy of claiming early versus claiming later, and I look at my retirement time horizon, whether it's a short time horizon or a long time horizon, the only way that it works out to claim early is that if I claim early, it's worked out. I get a lesser benefit, but my I die early, so it worked out. But if I claim early and my time horizon is actually longer, I've permanently reduced my lifestyle because the benefit just isn't as good. If I claim late and I have a short retirement, it's minimal harm done. Because at the end of the day, again, a spouse could still use that. And at the end of the day, it's not necessarily there. It's there to kind of provide a baseline, for your needs. And then if you claim late and you have a longer time horizon, you've permanently increased the lifestyle. And again, that's where I think that most people will fall, is that they're going to live longer than they think. And at the end of the day, they've permanently increased their lifestyle because of the deferral credits that they're going to get 8% a year. You think about it as that 8% a year raise that you get for every a year that you defer. So to me, that's the crux of the issue. It really should be less about kind of a break-even analysis and more about, okay, what is the impact that a decision like this can have permanently on my lifestyle, and what is it that we're really trying to tackle. I would argue that the Social Security should be more, again, looking through from an insurance, mitigating risk, and then the portfolio is where you're really trying to maximize vacation and grandkids and things like that. So everyone's going to be different, but to me, and I think people are starting to come around on this as they really look at this and they see, hey, we're just living longer, inflation protected, all those things that we talked about in these segments. But it is a really important decision. If we haven't got that point across, that you want to make sure that you're looking at this from an analytical approach, and then overlaying that again with what your goals are in retirement.
Yeah, and I think what you're highlighting here, which is really interesting, something I hadn't considered before, is this is a framework, a mindset in terms of, are you thinking about this more from the investment strategy, more from the insurance, and kind of bringing us full circle. Like what I'm interpreting is if you're able to plan earlier and throughout your career by building other investment streams that you can pull from, it allows you to have maybe some more freedom and peace in mind, and viewing that Social Security as an insurance piece and less as a need on the investment side. So I think that's a really, really great example, and something that seems obvious that we need to be thinking about in great detail. Tim, this has been great. 10 common Social Security mistakes to avoid. We're going to continue to build out more information on this topic. I hope, as we've highlighted, so much to consider around Social Security as a part of the financial plan. We've just scratched the surface really here in these 2 episodes. We also did an introductory episode on Social Security back on 242. We'll link to that in the show notes, but much more to come. And we're going to tap into Tim's expertise and the expertise of the planning team at YFP Planning to really bring us some more content in this area. So Tim, as always, appreciate your time, and looking forward to more coming on this topic.
Yeah, it was fun, Tim. Thanks.
As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.